Hi, welcome to another episode of the Financial Freedom Podcast. I'm Steve Richardson, a bankruptcy attorney trying to keep people on their path to financial stability and independence through education. Tax time can be very stressful for folks, especially if they owe money. For those struggling with debt and trying to pay the bills, it's even worse. But it may not always have to be. Tax planning throughout the year is a good idea if you want to minimize your taxes or maximize your refund when you ultimately file your return. That's why in this episode of the podcast, I talk with financial advisor Frank Buchholz about strategies you might be able to use to be in better shape when you file your next tax return. My guest today is Frank Buchholz, a retired senior vice president and financial advisor with over 40 years of experience in the investment industry. As a trusted professional with a reputation for clarity and compassion, he dedicated his career to helping individuals achieve financial independence through simple, effective strategies. Driven by a mission to make investing accessible to everyone, Frank became known for his user-friendly approach, demystifying complex financial concepts and empowering clients to take charge of their financial futures. Welcome to the show, Frank.
Thank you, Steve. Appreciate having me on. Thank you.
Yeah, so we're knee deep in tax season, where this is being recorded beginning of March. So a lot of folks are, if they haven't already, gathering their W-2s and 1099s together to prepare their individual returns. So obviously they want to keep as much as money as they can. Certainly not, they don't want to owe anymore, and even better if they can get a refund. So I wanted to talk to you today about some of the stuff that people can do now when they're preparing their taxes to keep more of the money that they've earned. So what can you tell us about some of the things that they can do to get more on the closer to the refund side than the owing side?
So for calendar year 2024, it's pretty well done, with the exception of the ability to contribute to a traditional IRA.
Mm-hmm.
If you have the ability to contribute to a traditional IRA, those funds are fully deductible against your income, both state and federal.
Mm-hmm.
And that, of course, may be a way to minimize or help minimize your tax liability. Plus, the money grows, of course, tax-free until withdrawn on a traditional IRA, at which point those funds become fully taxable, both state and federal. So that is certainly one way to minimize the tax for 2024. On a go-forward basis, a client may consider using the Roth IRA in lieu of the traditional IRA, because I feel that's a much better value, if you will. The difference between the two, of course, is that with the traditional IRA, it is tax deductible for the calendar year in which you take the money, which you up to April 15th, you can use that as tax deductibility against the income from the previous year. With the Roth IRA, your money grows tax free, and of course, it's tax free when withdrawn, but you do not get the deductibility item that associated with the traditional IRA. So there's a little bit different nuances. I feel by far and away, though, the better of the two is the Roth IRA, because to take the tax deduction today is not going to be all that valuable if you're taking, when you compare that to the taxability feature or tax-free feature of the withdrawal from a Roth IRA.
Mm-hmm.
So I
Well,
always encourage
circumstances.
clients to do a Roth IRA if they can.
Mm-hmm. Well, circumstances are different for different people. So,
That's
sometimes
correct.
there can be tax advantages now. I mean, uh, if you're looking at traditional IRA and you have that you're paying lower taxes, maybe you're making a lot more money now than you may in retirement and be in a higher tax bracket.
That's
Where
true
that
too.
traditional IRA now, you might benefit more from the um, not paying taxes now and then just paying taxes on the growth as you take it out. So it
Right.
can
I think it
depend
depends
upon
upon
the
yeah.
situation, right?
Yeah, I think it really depends on the person's age too. Because if a
Mm-hmm.
person's say 30 years old, their tax liability may not be that great, and they
Mm-hmm.
have a long runway to let that money grow on an IRA account. Now, if the person's 60 years old, then of course it's a different animal. Then of
Right.
course they may be better off with a traditional IRA in terms of deductibility. For the most part, though, my clients were contributing to IRAs were on the younger side. That's why
Mm-hmm.
I skewed those comments towards those particular clients. In terms of the people contributing at 60 years old, they weren't terribly enthusiastic about it because most people by then had already, people I dealt with anyway, had already made their funds, and they weren't super enthusiastic about contributing, seven or $8,000 to a Roth IRA or a traditional IRA, either one.
Mhm.
So it kind of depends upon, like I say, the situation, the time frame, and the tax liability or tax brackets now versus when you retire.
Mhm. So you can make contributions to, um, as I understand it, both either a Roth IRA or a traditional IRA up to April 15th or whatever the filing deadline is, or
Right now, but the major difference, of course, is the fact that you can't deduct the contribution for previous tax year on a Roth IRA, but you can certainly do it till April 15th for the traditional IRA, and of course you can contribute to the Roth IRA pretty much anytime throughout the year, but it would count in the year you made the contribution to.
so right. So you'd have to, if you want to get the tax benefit of the traditional IRA, you'd have to do it by April 15th.
Absolutely correct. Yep, absolutely
But
correct. Yeah.
as far as limits on, there are certain contribution limits, which we'll get to in a moment, uh, contribution limits. But if you can contribute to a Roth IRA by April 15th or whatever the IRS filing deadline is, you can, that money can be attributed to, in this case, the 2024 contribution limit. And
Right.
then
That's
you can
correct. Yes,
make
that's
a
correct.
contribution to an IRA later this year
That's
to count
correct.
towards this year, right?
That's absolutely correct. Yep.
Now, can you, for example, can you do both? Can you be strategic? So let's say your accountant is preparing your tax return and says, look, your taxable income is bumping up into the next tax bracket. But if you contribute X dollars to a traditional IRA, maybe not your whole contribution cap, but a portion of it, you can split it and say, okay, let's drop down below, keep from going to a higher tax bracket by contributing enough to a traditional IRA, and then put the rest of your money into a Roth IRA. Can you do that?
That is a good question. To be honest with you, I never had a client ever pose that with me. Uh, I kind of question it only because you are limited in terms of how much you can contribute to both IRAs.
Mhm,
You might be able to split the difference,
mhm.
where you have half the money going into one, half the money going in the other. But I don't that would make sense. But I don't think you do. I don't think you maximize the contribution to both IRAs.
Oh
You
no,
follow
I'm
me?
not saying.
No.
So let's talk about maximum contributions now, so
Right.
that my question makes sense. So you can't there's a maximum amount you can contribute to a Roth IRA or a traditional IRA,
Correct. Correct.
and what are those amounts?
Those are $7,000 for an individual that's 50 or younger, and $8,000 for an individual that's 50 or older.
Right. And those caps are for IRAs, period, right? So you can't
Right.
if you're over uh 55, whatever if it's 7,000, right? You can't contribute 7,000 to a traditional and 7,000 to a Roth, right?
No, no, that would not go.
That's
No.
definitely not. But if you took that, I guess my question is, and to clarify my question, is all right, so maximum you can contribute is 7,000, but if you were to contribute 3,000 to a traditional IRA
Right. And four
to
thousand to
drop
Roth.
to keep you from popping into a higher tax bracket, and then the
Right.
other four into a Roth for the
Right.
rest of it. Would that work?
I think that would work. That's correct. Yep.
Okay.
But you have to be careful with the quote unquote, the your income levels, because
Mhm.
if a person's making $500,000, they can't contribute to either one of them.
Right. And
So
that
if you,
was my next question. I was going to
okay,
talk
sorry,
about.
I didn't mean to
No,
bring
no,
something twisted.
yeah, that was my next question. And absolutely. So the
Sure.
folks out there know with these IRAs, as you said, it's you can maximum 7,000 to an IRA, whether it's Roth or traditional or a combination of the two.
Correct. Correct.
And if you're over, I think you said 55,
Actually, 50.
50, okay.
50. Yeah. 50.
Um,
Yeah.
that's way in my rear view mirror. I've been I've been doing the additional 1,000 for years. Uh, but so it's combined for both, but there's also an income limit. So
Correct. Correct.
to a Roth IRA, right?
Right.
So you may have that cap, but you might not be able to contribute anything if you're above a certain income level, right?
Correct, correct.
Okay. And what are those income levels?
So basically, if you're married, it caps out 246. So if
Mhm.
you make $247,000, you can't contribute to a Roth IRA.
Can't contribute at all.
No, no,
Now, is
can't
there,
contribute.
and I think the last time I looked at this, uh, there is sort of a middle ground where you can contribute, but you don't get the full maximum. In other words, if it's seven thousand
Right,
dollars, you may be able to contribute, but that maximum lowers in that gray area,
right, right.
right?
And it gets a little complicated. Is what they call this adjusted gross income, if you level, if you will.
Hmm.
So on the married for the Roth is between 236 and 246. So now if you're below 236 and you're married, then you can take the full, you contribute the full amount.
Hmm.
And then if you're single, buying is between 150 and 165.
Hmm.
So if you're 165 and you're single, then you can't contribute to a Roth IRA either.
Hmm.
So, but the benefit, of course, once again, is that the Roth IRA does allow for higher amounts of income and still have the ability to contribute to the Roth IRA. Whereas the traditional IRA, your joint income by married couple is 146, which is $100,000 lower than the Roth IRA. So if you're married and two of you are making 146 or less, you both contribute to your traditional IRA and
Hmm.
receive the tax deduction. So there are some benefits there. And of course, if you're single, it's between 79 and 89. $89,000, of course, excludes you from contributing to a traditional IRA. So
Hmm.
there are these various income levels. The one key point I want to make too is the fact that the IRS does continue to change these pretty much not every year, but fairly frequently,
Hmm.
in the fact that the contribution limits have gone up this year again. And then, of course, the income levels, I believe, have gone up as well. So you got to kind of keep an eye on that as well in terms on a go forward basis. And those
Hmm.
are very easy to find on the internet as far as your IRA and traditional IRA and Roth IRA contribution limits and so on. So, but I would keep an eye on that because the more you can contribute, if you have the ability to do so, the more the benefit will be to you as a retiree when you do retire.
Hmm. And just to clarify too, when we were talking about income, we're not just talking about a paycheck. So, for
Right,
example, you have a husband and wife, and they both have jobs, and the W-2s come in, and each of them made a certain amount of money total for that tax year if they're filing jointly. But but if they also had dividend income or a capital gains income during that period of time, or some other source
or
of
rental
income,
income, sure.
that counts in, right, to that total. So
Yep,
it's not just your paycheck.
absolutely. Right, exactly right. That's a good point. Absolutely.
So that this is something for the listeners out there that are considering this tactic in trying to reduce taxable income. You need to talk to your accountant about what your income levels are, and if you are able to contribute, really how much money you can afford to. I mean, we can talk about maximum contribution limits, but that doesn't mean you have the money available to do it
Exactly.
either.
Right,
But these
exactly.
are
100%.
right. These are parameters that our listeners should talk about with a tax professional before implementing any of these strategies.
Absolutely. In fact, they should do it the previous calendar year. Yeah, ask me. In other words, right now, they should really go in right now with the idea of maybe maxing out the traditional IRA, but
Mhm.
also look forward on a go forward basis as far as the calendar 25 as well to make sure that they're there. They can consider now, and the sooner they can contribute, the more that money grows in the long run.
Mhm.
So there's just kind of a twofold approach here as far as talking to the accountant, not just today, but also in the future.
Mhm. And now, I mean, it's still early in the year, but perhaps another thing they could do is if you regularly get a refund,
Mhm.
then maybe you need to file a new W-4 with your employer so that they're taking out less money and maybe use that money for a contribution to an IRA, traditional or Roth, and
Right.
you gain over time, and you're able to do that. It gets deducted from your pay, or you make the contribution yourself, and you're able to use that money in that tax year. Whereas if you get
Absolutely.
your refund,
Absolutely.
you've already you've already lost that opportunity because you've already filed the tax return, you've already gotten your refund, and that money could have been put into an IRA, both for your future, for your retirement and financial security and freedom then,
Absolutely.
but also better tax strategizing now because you've already put it into either a traditional IRA or a Roth IRA, and as far as that goes, and not just IRAs, right? We can talk about the ability now with a lot of if employers have 401ks, they may be able to put a Roth into 401k, right?
Absolutely correct. Yep.
So they should now that contribution still has to be made during the tax year. So
Correct.
that tactic is more going forward than
Correct.
for 2024.
Yep. Absolutely.
So other than a contribution to a traditional IRA, is there anything else that people can do now? Any tax credits or deductions or things that they can do to maybe minimize the chance of owing taxes or maximizing a refund?
I'm not familiar with any, to be honest,
Okay. Okay.
because it goes. I've always felt that when you want to do something, you want to do it with the calendar year,
Hmm.
and so since 24 is come and gone, the only thing I'm aware of is a traditional IRA contribution.
Hmm. So, all right. So let's talk about planning going forward for our 2025 taxes. What have we got? What ideas do you have as far as other things they can do besides an IRA contribution or that can help with their taxes for this year when they file in 2026?
Sure. So the major benefit that a lot of corporations now offer or companies is a 401k.
Hmm.
And again, the 401k is basically a it's a contributed with pre-tax dollars. And of
Hmm.
course, when the money's taken out, of course, it is taxable, both state and federal. So,
Hmm.
but having said that, your limits in terms of a 401k are much higher than the IRA accounts are.
Hmm.
And oftentimes the employer will contribute to the 401k as well. So in my case, what I did is I actually stopped contributing to the traditional IRA from way back when,
Hmm.
and I went as much as I could into the 401k, which I started mine in 1986.
Hmm.
And I contributed the maximum amount I possibly could each and every year,
Hmm.
and those monies grow over time. And then, of course, it also is with pre-tax money, which is kind of in effect a deduction because you're not taxing the money when you put the money in. It's almost like the traditional IRA. And of course, your contribution limits are much higher with a 401k than they would be with a traditional or Roth IRA.
Hmm.
So I'd utilize that strategy every year I possibly could.
Right. And then and that combined with, like I said, converting a getting back, clawing back that refund during the tax year by filing a new W-4. Now you have more money that, hey, it would have gone to it would have been deducted for taxes, so you're not relying on
Yeah,
it in your budget. If you put that into a 401k, then you're getting a tax advantage. B, if
absolutely.
matching funds, you're getting 100% return on investment as soon as the
Yep,
money's put into the fund because of the matching funds. So
exactly.
it's sort of a double whammy, both for now as a tax advantage and later for your retirement. You'll have more money.
Exactly right.
Hmm.
Exactly right. And retirement is so important to me because in doing the research in the book, I did not realize this at the time because I was dealing with the wealthy clients from Orange County, California.
Hmm.
However, having said that, I found out that half of people in America retire with no money saved for retirement,
Hmm.
literally half. So they're relying upon Social Security and potentiality of a pension.
Hmm.
So, to my way of thinking, one of my strongest goals with my book is to try to reorient the people's thinking in terms of saving now and maybe foregoing some pleasures today so they can grow their money in retirement. Because if
Hmm.
you retire and you have money worries, that's gonna affect your health, and of course your health is going to affect everything, and it's kind of a lose-lose situation. So my one of my sole goals in the book was to reorient people's thinking.
Hmm.
Save for retirement now, and you will be forever grateful.
Hmm. It's just hard to get motivated, especially if you're in your 20s and 30s
It
and
is. I
retirement
know.
is that far off. It's
It
kind of
is.
hard to
It is.
you know put that money aside and make the sacrifice now.
No
But
question.
I can
No
tell you,
question.
I'm going to be retiring soon, and my wife's retiring this year, and we're starting to look back and say, uh, we're kind of glad we struggled with the lower income during that time and putting the money aside because
Yeah.
now we're going to have a comfortable retirement.
Yeah. Yeah. In my case, not to sound elitist or brag, but if I go online right now, look at my retirement account,
Hmm.
it's over $8.5 million.
Hmm.
And when I left the firm or retired at 21, there was not I didn't have an IRA account that was that large.
Hmm.
I have many clients who had more money than me on the trust side, my personal side, but my IRA account would have been the largest IRA account I would have had on my platform when I retired. So it can show you that the contribution limits, if you can max it out, as you're better off. And of course, if you do it starting earlier rather than later, that'll benefit you as well.
Hmm.
So the good news for my wife and myself is that we retired and we have thank God, we have no financial worries.
Hmm. All right, so we
So
talked about the 401k and the IRAs, both traditional and Roth, as far as tax strategy for this year. Any
mhm.
other thoughts or tactics that folks can use to
uh,
minimize their 2025 taxes?
I wanted to point out the contribution limits on 401k. It's $23,500 for people under 50 and $31,000 for people over 50. In terms of other deductibility items, I think that a lot of people really need to kind of get a better grasp in terms of how tax laws work and
Mhm.
or sit down with their CPA and have their CPA quiz them in terms of what they're doing. If they have a business, are they deducting everything they possibly can from a business? Are they taking the car license fees every year, property taxes, state income taxes, all these various deductibility items? And are their taxes being prepared by a CPA, a professional?
Mhm.
Because if they're doing it themselves, they may miss some great opportunities here. So
Mhm.
my thinking is that yeah, the accountant's going to charge them some money, but I think it's another investment. The CPA will more than likely ferret out some deductible items and ultimately save them money in the long run. Because once they figure out the deductible items, that'll save them money from that on in, assuming they have the same amount of deductible items.
Mhm.
So I highly recommend using a CPA and being fully aware of the deductible items.
Mhm.
So, if they have rental property, if they have a car they use for business, there is the depreciation potentiality. So there's a lot of different ways, a lot of nuances that taxes can be minimized, but candidly, they get a little complicated for the average layperson.
Mhm.
That's the reason I recommend using a CPA.
So, are there any things that, it may not apply to everybody, but there are some credits and deductions that are out there that may get them, make it worth itemizing above the standard deduction that they could ask their CPA about so that people can be a little bit more proactive and say, hey, can I get this, or this? Because they know their situations may be better than the accountant does, especially if they go to
Sure, sure.
this is the
And
first
I
time
think I
they've
think
gone.
one avenue to explore, of course, would be real estate, because real estate does offer a lot of tax advantages. And of course, there's also the potentiality of appreciation, not only in the underlying value of the property, but also with the potentiality of income being received from the rents, if you will. Now, of
Mhm.
course, that's maybe for a little bit more affluent clients.
Mhm.
But in my world, we did have some clients that's all they did was real estate.
Mhm.
So my job, of course, is to help them manage their short-term money typically, and
Mhm.
or a investment account off to the side. But real estate can be certainly a beneficial way to achieve some deductibility in terms of taxes. But again, I think the major focus would be for the average layperson that's husband and wife both working. Are there any areas where they're overlooking deductibility of potential expenses?
Mhm.
Again, that comes down to the CPA in terms of looking for ways to come up with deductibility. It can be kind of a little bit of a hornet's nest because sometimes there are programs out there that promise you the world in terms of deductibility. And then, of course, you file the taxes and you get the refund. And 5 years later, the IRS says, nope, you can't do that. So there is some nuances here where I've seen where it can get kind of hairy.
Mhm.
So there is always that issue in terms of will this fly, and the IRS is will this be okay for the IRS in terms of their what they're seeing. not only today, but 5 years down the road.
Mhm. Which gets me on to my next question, which is, there are a lot of tax tips out there, and you see things on the internet that really look good. Uh, and some of the tips are good, and some of them are not so good, and might
Right.
end, result in you being in trouble with the IRS or your state taxing authority, a few years down the road. How does people spot the good advice from the scams?
I think one way is to look at and see who's actually offering this quote unquote opportunity, if you will.
Hmm.
Um, I did have a client who found out about some strange way to deductibility called a conservancy, et cetera, and they were quote unquote doing some buying some property and you got to have it converted to a conservancy and blah blah blah. Anyway, it was in the Wall Street Journal about a year later the fact that their IRS is investigating that now. So I think that the bottom line is that whoever's offering it has to be, to my way of thinking, completely legitimate. And one way to ferret that out is to see who's offering it. And if it's offered by a major league firm, such as J.P. Morgan and Merrill Lynch, Morgan Stanley, it's Raymond James, et cetera,
Hmm.
those firms have a monster concern about reputational risk, and they will check those ideas out thoroughly before they're allowed to be offered to the financial advisors. If it's a tiny little investment firm, it's a five person shop, if you will, they don't have the capabilities to really check these things out. So I've always believed in working with one of the larger firms because you will not have to worry about these issues. And God forbid there is an issue. Well, then of course there will be certainly a somebody to go after, if you will, in the end, versus people who could disappear in the night. So there is a certain amount of caution here uh, in terms of all these various ideas, if you will. So I would be very careful about if it sounds too good to be true, it probably is. So that's kind of my advice to the average layperson, not only with deductibility but also with investing as well. Remember, it was Bernie Madoff, who, of course, rip people off for millions of dollars, and of course he didn't do any trades. And of course,
Right.
would that happen? Can you lose money at one of these major league firms? Yes, but at least you're not going to get screwed. You're not going to get cheated. You're not going to get conned. So
And those are a
you
lot of
know,
sophisticated investors that got taken
yes, they
by it.
were. Yes, they were. And
Uh,
of course,
and you're talking about reputation in established firms.
yes,
He was president of NASDAQ. I
he
mean,
was. Yes, he
he
was.
had a huge reputation as being very legitimate. So people would trust him, but it just goes back to the common sense thing. No matter how reputable they may be, if it's too good to be true, it probably is.
Yes, and of course, he was a kind of a one man bucket shop. He had his family working there, and so on and so forth. And I'll never forget one time we were told that Bank of America interviewed him in terms of a potential, money manager. Well,
Mhm.
he couldn't produce an audited statement from an accountant. So they said, no way, we're out of here down the road. And thank God, because there again, there's this fiduciary duty to oversee what they're recommending in terms of who they're allowing on their platform.
Right.
So and
Exactly.
you'll notice that none of the big firms did business with Bernie Madoff.
Yeah. So it goes back to, and there were a couple of biopics or biopics that were done about Madoff, and in one of them, the guy that was I forget the name of the guy. He was tasked with sort of reverse engineering what Madoff was doing, so that his employer could do the same thing. And in doing that, he realized it was a Ponzi scheme. And he put it
Yeah,
this way: he
yeah,
says, what would you say if there was a baseball player that had a batting average of 850.
yeah. No way.
And after jokingly saying I'd get him a jersey, he said he's cheating.
Yeah,
And I
yeah,
said, well, he said, well, Bernie Madoff is batting 850.
yeah, yeah. And of course, his returns were constant every year. Well, you're not gonna have constant returns in the stock market, no matter what you do.
And he had, I think he pointed out, says he had a handful of bad quarters over the past 20 years, and that simply doesn't happen. Nobody's
No,
that good.
no,
So that's
no, no,
just
not at
something to
all.
bear in mind.
Not at all. Not a chance. Not a
Hmm.
chance.
So you've been referencing your book,
Right.
a book that you've written. let's talk about that. It's coming out. We're recording this on March 3rd, and it's coming out on the 11th, so it'll be out by the
Correct.
time this episode is published. So, what's the title of your book, and how does it help
So,
folks?
there it is, the Investor's Golden Playbook.
Okay.
And this is literally the work of three years. I retired at the end of 21, so I worked on it 22, 23, 24. Now I'm finally getting it done here, finally.
Hmm.
And the basic premise, of course, is that this is for people that can use some guidance in terms of investments. It's not going to give you a book on which stocks to buy and which stocks to sell and so on and so forth, but it
Hmm.
does give you a lot of guidance in terms of how to invest your money to get the best possible return. And of course, in doing the research for the book, and of course knowing it anyway, the best returns in the market have been in the stock market over the last 50 years typically. And your average returns in the stock market have been 10%.
Hmm.
And for every 4 years, you'll have 3 winning years and 1 losing year. And most of those 3 years are going to be above 10%. And of course, you will have typically 1 losing year. And of course, let's face it, the last losing year, we have a 22, when of course the Federal Reserve is forced to raise rates because of the inflation brought about by too much government spending.
Hmm.
So bottom line, of course, is that if a client can and has a long time horizon,
Hmm.
the stocks, of course, are a very, very good way to go in terms of investing. They have to have the money to be able to set aside and have money set elsewhere so they live on, et cetera. But if you have a 5 year window, typically at a minimum, you can do generally pretty darn well in the stock market. And
Hmm.
that's how I invested my 401k all the way through in the stock market, all the way through from 1986 till 2021, when I finally rolled over to buy IRA with Merrill Lynch. All the money was in the stocks, every penny.
Hmm.
So I'm a firm believer in that particular avenue for investing. And also, too, I do talk about all the various nuances in terms of stocks and bonds, et cetera, and give people a lot of information about these various topics. But what I try to do is try to present the book in a non-college textbook edition, if you will. In other words, you can go to your local bookstore now, Investing 101 and so on and so forth. And those books to me are boring as tears. With this book, I have real client experiences. And in chapter 1, I talk about my favorite client, whose name is Leo Arena, and what he had done over the time frame. And basically entire chapter devoted to one person and how that person succeeded so admirably. And he originally bought his original Bank of America stock from APG and Giannini, the founder of Bay of A, way back when he was living in San Jose as a dentist.
Hmm.
So he was kind of my hero, and that's how I got. That's why I bring the book to life. And then of course my next chapter, of course, is basically pay yourself first, which of course gets back to retirement accounts and saving money and investing money so you can have a nice retirement and so on. So I try to break it down into 12 golden rules about money and investing and make it interesting. And there are some mistakes people made, some good things that people did, and I highlight these with stories about actual people, if you
Hmm.
will, my former clients. So it's a little different than your typical investment book.
Oh, okay, great. So, we'll get for folks interested in getting the book, we'll have a link in the show notes on how you can get it. Beside this book you've written, Frank, are there any other services you offer folks? If other
Well,
ways in which you help people?
yeah, and of course, one thing we can do is if they, I set up an email on my website. The website, of course, is Investors Golden Playbook. The benefit there, of course, is that they can email me and I give them some advice. Now, having said that, it's going to be somewhat generic
Hmm.
because I never no longer have a financial securities license.
Hmm.
So, but a client says to me, well, should I invest in stocks? My retort would be, well, what's your time frame? If you have a
Right.
5 year time frame, yes, you can do that. But I'm not going to tell them which stocks to buy, obviously, or what mutual fund to buy, or which money manager to buy, or what use. You know what I'm saying? So it's going to be somewhat generic, but yet I can kind of give them some information so they can kind of put the rest of the pieces of the puzzle together, if you will.
Right.
So, but I'm more than willing to do that, and of course that's on my website, and there's a link there. And the first thing, of course, where they would get a planning worksheet, which
Hmm.
talks about the risk tolerance or time horizon and so on,
Hmm.
and that also provides me some information which would give me better information from them, so I give them a better suggestion.
Hmm.
So it's kind of a two-way street. So I can definitely offer some additional advice, no question.
Excellent. All right. So we'll have those links in the show notes as well. So
Thank you.
thanks for coming on the show, Frank.
My pleasure, Steve.
Good dive
Thank
into
you.
what people can do now and in the future for making sure that they keep as much as their money as they can,
Yes,
to spend it as they wish to have good financial freedom now and in the future.
absolutely. I appreciate it. Thank you very much.